Cousins Properties beat consensus across the board this morning. Q2 net income came in at $26.2 million, or 16 cents per share, which, is a massive step up from the 9 cents reported a year ago.
Right, yeah.
And funds from operations, or FFO, hit $124.6 million. That translates to 75 cents per share, up from 70 cents. Second quarter rental property revenues landed at $265.7 million.
Mm-hmm.
But looking ahead, management immediately raised the midpoint of their 2026 earnings guidance. So they're projecting full-year FFO between $2.92 and $2.98 per share, basically lifting that previous floor of $2.90.
Yeah, that's the big signal.
And they put the net income projection between 8 and 14 cents. Shares are currently trading up about 2.5% on the news.
I mean, those are just massive headline beats. In the current commercial real estate environment where, so many operators are heavily distressed.
Oh, absolutely.
Seeing a REIT not only beat expectations, but actually raise their forward guidance, that demands our immediate attention.
So here is the mission for today's deep dive.
Okay.
For you, the retail investor listening to this, we are taking these headline figures and dissecting the actual mechanics behind them.
Right.
We're going to look under the hood at segment performance, operational margins, the highly aggressive strategic portfolio shifts they're executing right now, and this is key, the very specific macro risks lurking in that forward guidance. Okay, let's unpack this.
Well, the physical occupancy is the engine for all of this, right?
Right.
The financial metrics, the FFO and revenue beats we just listed, they don't just materialize out of thin air.
Right, exactly.
They are the direct result of leasing volume.
Yeah.
And the data from Q2 shows a very robust engine. Cousins executed 924,000 square feet of office leases in a single quarter.
But the sheer volume isn't even the most interesting part there. It's the composition. Out of that 924,000 square feet, 43%, that is 395,000 square feet, was entirely new and expansion leases.
That's huge.
If this were just defensive renewals where tenants are merely keeping the space they already have, I really wouldn't be as impressed. But 43% means active growth. They are pulling tenants in from somewhere else.
It's active and it's highly selective. That leasing momentum actually pushed the total portfolio to 92.8% leased.
Wow.
And just to put that into perspective for you listening, that is the highest leased level Cousins has seen since the first quarter of 2020.
That's wild.
They have essentially climbed all the way back to their pre-pandemic high water mark, right before the entire commercial real estate sector was turned completely upside down.
Which brings us directly to the commentary from CEO Colin Connolly, because his framing of the market explains how they're pulling this off. He pointed out the clear bifurcation happening right now between Sunbelt markets and gateway markets.
Yeah, the geographical divide.
We all know the broader, terrifying narrative for investors, right? The death of the office. But Cousins is painting a picture where that narrative is highly regionalized.
It really is a tale of two distinct markets right now. Gateway cities, your traditional financial and coastal hubs like New York, San Francisco, Chicago, they are still fighting through fundamental occupancy and valuation issues.
Right.
But the Sun Belt, where Cousins exclusively operates in markets like Austin, Atlanta, Charlotte, and Phoenix, is experiencing a totally different dynamic. Connolly noted that trophy office fundamentals in the Sun Belt are actually tightening.
Meaning less supply.
Exactly.
Yeah.
The available supply of high-end space is shrinking, which means the flight to quality is accelerating.
Let's talk about that flight to quality, actually, because Cousins specifically brands this strategy under the banner of the lifestyle office. And I look at this branding, and frankly, I see an all-inclusive luxury resort amenities race for corporate tenants. You look at the blueprints for these buildings, and they feature high-end fitness centers, barista bars, expansive outdoor terraces, and, highly curated tenant events.
Yeah, it's wild.
That is a full-blown hospitality approach applied to a desk and a chair.
It's the complete corporatization of hospitality. I mean, the landlord is no longer just providing four walls and an HVAC system. They are providing an employee retention tool for the corporation leasing the space.
But I have to push back here. Is this lifestyle branding actually translating to real pricing power? Or is it just, corporate real estate jargon designed to justify the incredibly high development and maintenance costs of these Class A towers?
It's a fair question.
Because Putting a cold brew tap in the lobby, staffing a full concierge, maintaining luxury terraces, that is incredibly expensive. You'd think the capital expenditures for those amenities would just bleed their operating profits dry. Are they actually getting a return on that investment?
What's fascinating here is that the margin expansion provides the exact proof of that pricing power.
Really?
Yeah, the numbers completely validate the jargon. We aren't seeing operating expenses eat their profits. We're seeing the opposite. If we look at the operational efficiency in Q2, the same property net operating income, or NOI, on a cash basis increased by 5.9%.
Just to underscore that for you listening, a 5.9% increase in same-store NOI is massive, especially in an environment where many office operators are just fighting tooth and nail to keep their revenues flat year over year.
Exactly. And the metric that really answers your question about whether the lifestyle entities generate pricing power is the second-generation rent spread.
Right.
For the second quarter, second-generation net rent per square foot on a cash basis increased by 9.2%.
That is the defining number right there.
Yep.
A 9.2% cash rent spread means that when an old lease expired and a brand new lease was signed for that exact same space, Cousins was able to charge 9.2% more than the previous tenant was paying. That only happens if the tenant feels they have absolutely no leverage in the negotiation, because they desperately need to be in that specific lifestyle building to attract their workers back to the office.
It proves the amenities race functions as a yield generator, not a cost center. They are passing the inflationary costs of those amenities right back to the tenant, and the tenant is willingly paying it.
Right.
However, we've established they have immense pricing power and expanding margins. So if the core business is booming, why did their 6-month GAAP net income absolutely crater?
Yeah, we do need to look at this discrepancy. For retail investors reviewing the 6-month data, there's a massive cliff here. We established that the 6-month FFO was rock solid at $247.5 million.
Right.
But if you look at the GAAP net income for the first 6 months of the year, it fell to just $1.3 million, or a single penny per share. That is down drastically from $35.4 million in the same period last year. So what does this all mean?
If you're holding the stock, you might panic seeing a $35 million drop in net income. But as a REIT investor, you have to look past the GAAP illusion. This is a textbook example of why we rely on funds from operations rather than just GAAP net income. That massive drop is primarily driven by a singular non-cash event: a $36.6 million operating property impairment charge taken earlier in the year.
Let's break down the mechanics of an impairment charge for a second. It basically means management looked at a building they own, realized it's worth less on the open market today than what they originally recorded on their balance sheet, and formally marked down its value.
Yep, they took the hit.
And that accounting markdown flows through the income statement and just crushes the GAAP net income. But, and this is the key, it doesn't actually impact the cash-generating ability of their day-to-day operations.
Exactly.
They didn't lose $36.6 million in cash, they just took a paper loss. That is why the FFO, which measures actual cash from operations, remains incredibly strong.
And understanding why they proactively chose to take that $36.6 million hit on the chin is crucial. It isn't just a random accounting adjustment forced upon them by auditors.
Right.
It is the direct trigger for their broader capital recycling strategy. Sometimes, to reshape your portfolio for the future, you just have to take a paper loss today to clear an older asset off your books and free up the capital.
Think of it like a fantasy football trade. You decide to drop a solid, older player who is slightly past their prime. Taking that hit might lower your team's overall stats this week, but it frees up the salary cap space you desperately need to draft a rookie superstar who is going to dominate your league for the next 10 years.
That's a great way to look at it.
That $36.6 million impairment is just the strategic cost of clearing the roster, which leads us into the actual transaction activity, specifically what I'm calling the Austin Shuffle.
Oh, yeah, the Austin Shuffle.
Let's walk through this sequence because it shows you exactly how management is executing this roster change.
So during the quarter, they sold Research Park Plaza 5, which is a 173,000 square foot property in Austin, for $42 million. That was a clean win, resulting in a $9.2 million gain. But the much bigger, more complex move happened just after the quarter ended.
Right. On July 29th, they closed the sale of 111 Congress. This is a massive 519,000 square foot office property in Austin. and they sold it for a gross price of $208 million.
Hmm.
This was the specific asset tied to that $36.6 million impairment charge we just discussed. They recognized the paper loss specifically so they could clear the asset off the board and harvest that $208 million in cash.
And the obvious question is, where does that $208 million go? Because in capital recycling, the sale is only half the equation.
Right.
Simultaneously, Cousins committed $31.5 million to a preferred equity interest in a brand new 199,000 square foot development in Austin called Fifth and Walsh.
And let's look at the mechanics of why they chose preferred equity instead of just buying the building outright.
Yeah, this is important.
By taking a preferred equity position, Cousins gets priority returns on their investment and downside protection in a brand new development without taking on the full construction and leasing risk right this second. The capital is scheduled to be invested in 2027.
Right, it's very calculated.
So you look at the mechanics of the whole shuffle. They sell a massive, older 500,000 square foot tower, take the impairment hit, and instantly pivot that capital into a highly structured, lower risk equity position in a newer, smaller, theoretically much higher quality asset in the exact same market.
It is capital recycling executed perfectly. They are pruning the bottom tier of their portfolio to fund the top tier. And it wasn't just limited to Austin.
Oh, right. The Phoenix move.
Over in Phoenix, they bought out their joint venture partner's 10% interest in 100 Mill, which is a 287,000 square foot property for $18.5 million. This was based on a total property valuation of nearly $159 million. Why do that? Because they want to consolidate ownership in their most profitable, highest performing Sunbelt assets. They want 100% of the upside in that tightening market rather than splitting it with a partner.
But executing this, buying out partners, structuring forward equity commitments, aggressively transacting on massive towers that requires serious immediate liquidity.
Absolutely.
And doing this in the 2026 commercial real estate market where lenders are notoriously skittish and actively fleeing from the office sector, well, it makes their debt structuring update incredibly vital.
I would argue their debt update is the most bullish signal in the entire earnings report, even more than the leasing volume.
Really?
Yeah. During the second quarter, Cousins closed a new 5-year, $1.2 billion unsecured credit facility. This replaces their prior $1 billion facility. But it is not just the expanded size that matters, it is the terms of the debt.
Right. They actually improved their borrowing spread by 15 basis points on the credit facility, as well as on their $400 million term loan. And they secured a 30 basis point improvement on a $100 million term loan.
Which is huge.
For anyone listening who isn't staring at bond yields all day, a basis point is 1/100%.
Yep.
So a 15 basis point improvement means Cousins is getting their debt 0.15% cheaper.
Yep.
In a macro environment where borrowing money is getting wildly expensive for everyone else, their cost of capital is actually going down.
If we connect this to the bigger picture, the debt markets are telling you something very important here. Lenders are ruthlessly pragmatic. They do not care about lifestyle branding unless it produces cash.
Exactly. They care about the math.
If a syndicate of banks is willing to increase your unsecured credit facility to $1.2 billion and actually lower the spread you pay, it means the institutional capital markets fundamentally believe in the resilience of your specific portfolio. They are looking at that 92.8% occupancy and the 9.2% cash rent spreads, and they are pricing Cousins risk lower than the rest of the market. It gives management the dry powder they need to ruthlessly prune older assets and double down on their newest developments.
It is a massive institutional vote of confidence. The capital markets clearly trust them with the checkbook. But as a retail investor, you can't just look at the rosy side of the ledger.
Right.
You have to read the fine print. We need to look at what risks management is legally flagging on the horizon in their forward-looking statements.
Well, every earnings report features boilerplate risk factors, right?
Okay.
Fluctuations in interest rates, general supply chain disruptions, standard capital market volatility.
Sure.
We expect all of that, and it applies to every single REIT operating today.
So we are going to breeze right past that standard boilerplate because, honestly, you already know how interest rates work. Here's where it gets really interesting. In the fine print, management specifically highlights two highly unique risks that could fundamentally alter their trajectory.
The first one is a direct nod to technological disruption. Management explicitly noted risks associated with the, quote, adoption and usage of artificial intelligence.
This is huge to see formalized in a real estate document. When a REIT starts talking about AI and their legal risk factors, they aren't worried about robots taking over the building maintenance.
No, not at all.
They are implying a potential long-term structural disruption to corporate headcount and space utilization. The logic goes like this. If your core tenant is a massive tech firm or a financial institution, and they figure out how to use generative AI to execute the same amount of work with 20% fewer mid-level employees,
Right.
they simply aren't going to need as much square footage when their lease comes up for renewal in 5 years.
It directly threatens the underlying demand metrics that drive those strong rent spreads we talked about earlier. If companies need less space, the supply-demand dynamic of the trophy office flips entirely.
It really does.
And the second specific risk they flagged shifts from technology to the regulatory side.
Right. Management flagged the potential passage of the One Big Beautiful Bill Act and its impact on REIT tax laws. Now, let's be very clear here. Regardless of how you vote or how you feel about the politics of this specific bill, our job today is strictly to look at the math and the mechanics.
Exactly. We're just looking at the number.
The reality is, if this legislation passes, it fundamentally changes the tax code, which in turn changes how real estate investment trusts are required to structure their dividends and handle their corporate taxation. It's not a political statement from Cousins. It is an active regulatory variable that the C-suite is legally required to model for, and therefore you as an investor need to be aware of it.
This raises an important question regarding resilience. How will these dual forces, massive potential legislative shifts, altering dividend structures on one side, and tectonic technological shifts like AI reducing headcount on the other, test the fundamental strategy of the Sun Belt Trophy Office? Because right now, in this quarter, the strategy is working flawlessly. But the forward-looking risks suggest the playing field itself might change shape significantly over the next 5 to 10 years.
Which is exactly why you have to track these mechanics quarter to quarter, not just year to year.
Yeah.
So let's bring it all together and deliver a rapid synthesis of what you, the retail investor, need to take away from this deep dive.
Let's do it.
Cousins Properties beat the quarter across the board. They raised their forward guidance. They have achieved their highest occupancy since early 2020 through aggressive new leasing. And they are relentlessly recycling capital, taking calculated paper losses on older properties like 111 Congress to move money into brand new, highly amenitized Sunbelt projects like Fifth and Walsh. The financial data, specifically those 9.2% cash rent spreads, completely supports their argument that, at least in the Class A space, the office is far from dead.
Definitely.
The debt markets agree, rewarding them with cheaper borrowing costs on a massive $1.2 billion facility.
It is a very clean quarter that validates their specific investment thesis. The bifurcation between the gateway markets and the Sun Belt is real, and the flight to quality is measurable in their cash flow.
But I want to leave you with a final provocative thought to mull over as you look at your own portfolio. Management is essentially betting the farm on the lifestyle office.
They are.
They believe that adding high-end gyms, amazing common areas, and hospitality-level service is the ultimate key to luring workers back and retaining corporate tenants. But at the exact same time, they are legally flagging artificial intelligence as a core long-term risk.
Yeah, that tension is fascinating.
Think about the collision of those two ideas. If AI allows a corporate tenant to execute the exact same output with 30% fewer employees by the year 2030, will an on-site barista and a luxury gym really be enough to keep a massive 500,000 square foot tower 90% occupied?
That's the million-dollar question.
Or is this current flight to quality just a temporary, highly expensive Band-Aid on a permanently shrinking corporate footprint? It's a structural tension every real estate investor needs to be watching closely over the next few years.
Absolutely.
If you want to stay ahead of these trends and understand the mechanics behind the headlines, make sure you follow the show for daily, no-nonsense earnings coverage that cuts through the noise.